Joining me in studio is Jordan Toy from Legacy Family Wealth with his analysis of the current midday trading activity. Jordan, thanks so much for your time today. It is D-Day when it comes to tariffs. Trump moving forward with the 25% tariffs on Canada and Mexican imports and an additional tariff of 10% on China. This, of course, somewhat sparking a trade war as we are seeing, retaliatory moves from China. How concerned are you about this and how it impacts markets?
So certainly it's been a very busy morning and a very volatile morning. On the topic of the tariffs, I think it's something that we've spoken about at length, for some time. There were specifically the Canadian and Mexican tariffs were on the cards, then they were off. Now they're back on. I also saw that there was retaliatory tariffs out of China this morning. Yeah. So it seems that we're on the precipice of I think a trade war is quite a strong term, but having said that, the market reaction's been even stronger, and we're seeing quite a lot of movement in risk assets. It's a question of, do these remain in place? I mean, the rhetoric out of the Trump camp is changing hourly, not even daily at this point in time. So who knows where we go from here? I think it's well known as well that the tariffs in the longer term are clearly not a good thing for the world as a whole. Interestingly, the Chinese tariffs, I think they're in a position where they need to have some reaction.
Yes.
That they can't take this lying down. I saw that specifically they were focused a lot on agricultural exports from the US to China, so soybeans, corn. Those are the sort of largest export component in terms of the total mixture coming out of the US and going to China. But still only about 1.2% of those total exports. But all in all, not great for markets.
And it's interesting to see the dynamics with China, especially because they really rely on their export market as consumption has been under pressure, right, Jordan?
Yes, certainly. So we're seeing that very much so in specifically the automotive sector. China sort of front-loading a lot of their exports ahead of the expectation that these tariffs would be coming in. I think I was looking at calculations this morning out of Numero was saying that they think that the effective tariff rate on China from the US is around 33% now. Obviously, we've had an extra 20% since Trump came back in. So that's certainly going to put pressure on their exports, and hence why they were trying to front load a lot of those exports to the rest of the world before these tariffs came into effect.
I've been saying it's Trump's world and we just live in it. Moving over to news back at home, GDP figures out today. The economy rebounding at the end of 2024, expanding 0.6% in Q4 from a contraction of 0.1%. Also interesting to see that agri-sector rebounding after, it contributed to the negative print in Q3. What have you made of that print?
I think all in all, we know that the growth rate is much lower than we need it to be to really have a tangible impact. We're growing slower than our population's growing. So pleasing, I suppose, that it has moved from a contraction in the previous quarter, but nowhere near what we need it to be to see some tangible improvements in the economy as well as people's quality of life. So I think in that sense, disappointing figures. Expectations were largely sitting around 0.8%, so we've missed expectations as well. Especially when we also consider that this is the quarter where the two-pot system or the two-pot withdrawals really kicked in. And we did see that on the expenditure side, that household consumption had an impact. But it's not the saving grace that's come in and sort of revitalized GDP figures all on its own. And we'll see now, we're obviously in the new tax year, what that looks like going forward in terms of two-pot withdrawals, but certainly not sort of saving the whole GDP growth figure. And a lot more work to be done. We really need that growth figure to lift at least to the level of population growth so that we can start actually maintaining the standard of living as opposed to going back. I know that it's framed as growth, but when we factor in those other factors, we're actually largely moving backwards, albeit at a very low rate.
And sticking with that growth print, I know Nedbank recently said in their results that they expect growth to expand this year, just off the low base that we saw in 2024. The commentary, of course, coming alongside their annual results, where growth on that front in terms of earnings came in at 10% higher. On the revenue front, we see, net interest income muted and non-interest revenue rising. This expected, of course, in the current environment, right?
I think certainly. I think it was a decent set of results out of Nedbank. Credit losses improved. You obviously touched on most of the key figures there. So in that context and in the environment that the South African consumer finds themselves in, I think a largely decent set of results out of Nedbank. Dividend up. We're seeing revenues up marginally. So I think all in all a decent result. What I found quite interesting was there was a mention there of a slight restructuring in their private banking and wealth management divisions. I know that FirstRand undertook a somewhat similar exercise. So interested to see how that actually pans out and how they consolidate those different divisions and how they're changing sort of the path there. But yeah, all in all, not a bad set of results, all things considered.
Earnings season is heating up and we have numbers from Discovery as well. They're also showing growth across the board when it comes to their business units, and that helped lift overall earnings by over 30%. Walk me through your analysis of those results.
Yes, it's certainly been a busy morning for results, a lot to go through and a lot to sort of unpack in detail. So we're still busy going through a lot of what's come out today. But having said that, Discovery, at a high level, we're seeing very strong growth across, all the different metrics that we looked at. I think just about every percentage increase we were looking at was north of 10, 20%. So pleasing results out of Discovery. You mentioned they talked about scaled organic growth now going forward. I think that's largely, or a large part of that, speaking to the bank. That's a new area, well, relatively new area, if we can say that in the banking sense, but pleasing results out of the bank, growing nicely, and just sort of more of the same is what I picked up from that, in the sense of we've got these different areas now, and now it's just we need to scale and continue growing in those spaces. Pleasing results as well out of the UK and their stake in Ping An Insurance out of the East. So all in all, a solid set of results, and we'll have to see what the future looks like.
All right, let's just hit pause on the conversation. Before we get to your stock pick, let's reflect on some counters that have found favor with your industry peers.
Yeah, results are out this morning, and it's interesting comparing them with Italtile because Bidvest also had about a 1% increase in earnings, which by its standards is very low. But unlike Italtile, which is literally a litany of woes, none of them making, Bidvest basically says, well, we had a surprisingly bad result out of Adcock Ingram. We're having some difficulty locally, which is applicable to most local industries, whether it be, troubles with transport or consumer spend, and specifically also their automotive sector. But offshore's going great guns, and specifically their entry into Southeast Asia and Australia, which in any event is where I think growth is going to come from. Price-wise, the company's basically been flat between about 230 Rand and 300 Rand since January of 2023.
Yeah.
They're right at the bottom of that range on these results. I think if you want a steady, local, very well-managed companies at this price point, not a bad place to enter.
Yes, so it's had a healthy pullback, healthy 15% from its recent highs, but I think what's underappreciated is how well positioned it is to tap into this generative AI across a number of layers in the business. They're still the biggest cloud provider in the world. They have their Bedrock platform. They have the ability to sell that service to others and to use it internally. So you have this massive logistics business that is built for AI. You have this massive consumer advertising business. You have this, so everything they're doing, they've got Alexa Plus they've just launched, is really ripe for tapping into the synergies and the opportunity around. They've got their own inference chips. The list is endless. So they're probably one of the better positioned companies out there anywhere I look. And I think they are disciplined. They've got a good management team. Andy Jassy is doing an amazing job. So I'm quite excited about this one. I think for me, they're one of the better picks out there if you want to be in this space.
So Amazon and Bidvest, what have you made of those counters and the analysis some of our analysts have provided?
So just briefly, your guests, or rather your analyst there, mentioned Bidvest from both a price perspective, and I think he also touched on the fact that it's a good, stable South African business. I'd largely agree with that. I think, he was spot on in mentioning that the results were somewhat disappointing, I think, especially considering Bidvest's own standards, if I can call it that. And yes, we have to look at it, I think, mostly from that perspective. So if we look at it the last year, it's not been a great one in terms of the share price. So, from that perspective, maybe it's presenting a relatively interesting value point in terms of an entry point. But for me, at least, it's as he said, it's a stable company. I don't think it's necessarily an exciting sector or a rapid growth sector. So an interesting one, I think, largely a stable element to any portfolio. And then you mentioned Amazon as well, or your other guest mentioned Amazon. That's quite a contrast, right?
Yeah.
I suppose in the exciting AI field, there's lots of other divisions within Amazon, and I think that's a very interesting one to keep a close eye on. I mean, it's nothing new. It's a large company. Everybody's heard of Amazon pretty much. But we're seeing, not only massive revenues out of all of these divisions, but big growth. So specifically advertising was mentioned there. So I really like Amazon. I think it's one that should form sort of, if you have a tech exposure in your portfolio, it's definitely one to look at, because it's not a pure play on any one area, be it AI, they have a massive logistics business. So they've got all these different areas, but a really solid company and one that I like very much.
So you like both Bidvest and Amazon, but that's not your stock pick. We have about 20 seconds to go, so please let me know what you're hanging your hat on today.
Okay, I'll try to keep it brief. So Pick n Pay, I think is, let me be clear, maybe not a stock pick, but certainly one that should be on your watch list. If we just simply look at it, Boxer's up quite significantly this year. It's obviously been separated out of Pick n Pay. Pick n Pay largely down this year, yet Pick n Pay is still holding 2/3 of Boxer. And I think I echo a lot of what Keith McLaughlin has said on the topic. And, when we look at the numbers and just with some rough calculations, Pick n Pay, their holding in Boxer plus their cash is kind of worth more than the rest of the Pick n Pay business combined at the moment. So the read-through on this is that the market is basically valuing Pick n Pay's business on its own negatively, which I think is quite an interesting one to keep an eye on. Obviously a contrarian view, and ShopRite is dominating in that space. But, is 1 + 1 still equaling 2 here? I'm not so sure, and one that certainly requires a good look.
1 + 1 could be 11 in this case. Jordan, thanks so much for joining us and sharing your analysis on the day's markets action. That was Jordan Toy from Legacy Family Wealth.